Hello, my name is Philippe Vesser, and I briefly introduced myself in a previous video called Deficit, which dealt with the problem of controlling public deficits. I invite you to watch the video if you have not done so already. A second video, entitled Growth, dealt with the link between the public deficit and growth. Both videos discuss the consequences of a relationship that says that the sum of an economy's sectoral balances is nil. This relationship is well known in notional accounts. It was also established and used by Gurley and Shaw in a 1960 book called Money in a Theory of Finance. Normally, however, this relationship is rarely used in economic analysis, which prefers to use a much more complex relationship to deal with the consequences of the links among the sectors. This video will look at the latter and show how it considers a major problem dealt with in the deficit video, how sectors control their balance. Let me quickly remind you of some of the concepts presented in the deficit video. A sectoral balance is defined as the sum of all the revenue that a sector receives from other sectors for its economic activity minus the sum of all expenditures that it pays out to the other sectors. The revenues and expenditures considered are those of any nature generated by economic activity. Note that I say those of any nature, which means that they include not only consumer spending but also investment spending. The sum of an economy's sectoral balances is therefore zero. It is equal to the difference between the sum of all intersectoral revenues and the sum of all intersectoral expenditures. And for each revenue there is an expenditure of the same value and vice versa. But only on one condition, that every time the chosen system of national accounts records a revenue for one sector, it simultaneously records an expenditure for the same value in another sector, and vice versa. Each sectoral balance is also equal to the sum of the balances of each economic unit within that sector. The balance of an economic unit is defined as the balance between all revenues and all expenditures as a result of trade with other economic units, irrespective of whether they belong to the same sector or not. Revenues and expenditures from trade with an economic unit in the same sector are internal to that sector, whereas revenues and expenditures from trade with an economic unit in a different sector are intersectoral revenues and expenditures, and these are what determine the sector's balance. The sum of the balances of the units in a sector can be described as the sum of the balance between the sector's internal revenues and expenditures and the balance between the sector's intersectoral revenues and expenditures. However, if the accounting system applies the rule that any revenue should also be recorded as an expenditure and vice versa, then every internal revenue in the sector is cancelled out by the corresponding internal expenditure and vice versa. Internal revenues and expenditures cancel each other out, so the balance between internal revenue and internal expenditure within the sector is zero. And intersectoral revenues and expenditures, on the other hand, do not cancel each other out. An intersectoral revenue is recorded as a revenue in the sector of the unit that is receiving the revenue, and an expenditure in the sector that the revenue is coming from. The sum of the balances of the units in the sector is therefore equal to the balance between the sector's intersectoral revenues and expenditures. It is the sectoral balance as I defined it earlier. But what happens if the accounting system does not follow the rule of recording every revenue as an expenditure and vice versa? What if there is an exception to this rule? Let's imagine such an exception where a revenue, which we will call X, is not simultaneously recorded as an expenditure. In the sum of the sectoral balances, revenue X does not have a corresponding expenditure that cancels it out. This means that the sum of the sectoral balances is X, not 0. Every time that a revenue is not simultaneously recorded as an expenditure, it remains in the sum of the sectoral balances. Let's imagine a different exception to the rule, where it is an expenditure, which we will call Y, that is not simultaneously recorded as a revenue. In the sum of the sectoral balances, expenditure Y does not have a corresponding revenue that cancels it out. This means that the sum of the sectoral balances is minus Y, not 0. Every time that an expenditure is not simultaneously recorded as a revenue, it remains in the sum of the sectoral balances with a minus sign. If accounts contain revenue without corresponding expenditures and expenditures without corresponding revenue, the sum of the sectoral balances is equal to the sum of revenues that don't have a corresponding expenditure minus the sum of expenditures that don't have a corresponding revenue. Let's now look at the relationship generally used in economic analysis. This relationship is a result of replacing the corporate balance, which is also equal to the sum of the balances of corporations in the sector, with the sum of the net profits of corporations. What, then, is equal to the sum of corporate net profits, the household balance, the public balance, and the rest of the world balance? A corporation's balance is the difference between all of the corporation's revenues and all of its expenditures, whatever their nature. A corporation's net profit, on the other hand, is the balance between all its revenues and all its expenses. But these expenses do not include all expenditures from economic activity. Investment, for instance, is an expenditure from economic activity that is not part of the expenses used to calculate net profit. However, if the investment is made by another corporation in the same economy, that investment goes into its turnover. It is its revenue. If, on the other hand, the investment is imported, it is also recorded as a revenue, since imports are part of the rest of the world revenue. Since this revenue is not recorded as an expense, the investment remains in the sum total. Therefore, the first exception to the rule on the reciprocal recording of revenues and expenditures in the accounts is investment. The second is depreciation. since an investment not recorded as an expense is replaced by depreciation, which measures the decrease in value of the investment. Depreciation, however, is recorded in the expenses but not in the revenue. It therefore gets taken away from the sum total. The third and final exception is dividends. These payouts to shareholders are an expenditure generated by the economic activity and are recorded as such in the corporate balance as we have defined it. But dividends are not included in the expenses used to calculate net profit, even though it is a revenue for whichever sector receives that revenue, be it a corporation, a household, or the rest of the world. Because it is a revenue that is not recorded as an expense, the dividend remains in the total. So, the sum of the net profits and the three other balances is equal to investments minus depreciation plus dividends. It is obviously possible to reorganize the relationship so that one of its two sides is investment and refer to the second side as saving. This new relationship would be absolutely correct, but would not at all represent the financing of investment by this saving. Investment is in the equation because of an accounting convention. At the microeconomic level, it's true that a corporation's investment is a disbursement, an outflow from the corporation, and it must be financed. But what about at the macroeconomic level? An investment is either produced in the economy in question or it is imported. When it's produced within the economy, the investment is an internal flow within the corporate sector. And while, on the one hand, it flows out of the corporation making the investment, on the other, it flows into the corporation that produced it. Therefore, from the perspective of the corporate sector, it is not the flow that requires financing. When the investment is imported, however, it is a flow that leaves the corporate sector, and therefore a flow that requires financing. But this flow is already part of the equation. The term rest of the world is short for the rest of the world's revenue less its expenditure. These revenues from the rest of the world mainly consist of imports, including imported investments. So, imported investment appears twice in the relationship. Once in the rest of the world balance as an import, and here and only here is it as a flow that raises the macroeconomic problem of how it is financed, and once as an investment arising from an accounting rule. This shows that although the relationship showing the net profits is exact, it does not deal with the macroeconomic problem of financing investment or financing sectors. To understand the problem of the financing of sectors, we must return to the much simpler relationship that we saw in the deficit video, which shows that the sum of the sectoral balances in an economy is zero. In that relationship, the problem of controlling the public balance is clearly visible, unlike the net profit version, where it is concealed by the parasitic appearance of investment, depreciation, and the dividend. For a more in-depth analysis, read Reducing the Public Deficit, which is available as a hard copy on Amazon. The book goes into more detail, looking at several case studies, with data presented in the form of tables and graphs. Also, take a look at the website deficitandgrowth.com, which includes data regarding the countries for which the OECD provides the information that my analysis method requires. On the site, you can consult the data in the form used by my methods, and you can work with the data using simulation tools. A first YouTube video entitled Deficit deals with the problem of controlling public deficits. A second YouTube video called Growth looks at the link between growth and the public deficit. All of these publications are also available in French. Thank you for your time. Please feel free to send any comments to deficitandgrowth@gmail.com.